Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about should you take your pension as a lump sum payout, and particularly this presentation is relevant for those of you that are confronted with this question about whether you should take commuted value. We'll define commuted value in a moment from your pension plan and take control of those pension assets. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on quite literally all things retirement. We talk about the financial aspects of retirement, but we also talk about the non-financial, whether it's longevity and health, relationships, looking at various aspects of finding meaning, and of course leisure topics. Now, a big question that many people are confronted with is, do I take money out of my pension plan? And there's various things that can trigger those decisions. The more common ones would be you're changing employers, and so they have a pension plan, and when you leave, they're asking you to make some decisions about what you want to do with the pension plan. And one of the options might be to take those monies, transfer it to your own RSP account or to another pension plan. Another issue that comes up is you're about to retire, and so as you retire, your pension administrator is going to give you various pension options that you need to consider, and one option might be to take the pension value and take control of it at that date. Another reason is employers make changes to their pension plan. They wind down one pension, start up a new one, and as a consequence, there's a lump sum that you have to make a decision on. Now, before we get too far down the trail here, I want to define the two major kinds of pension plans that are out there, and then we're going to talk about one in more detail because it's relevant for this discussion. So the two main plans, and these aren't the only ones, but they would be the majority of people out there would have these plans if they have an employer-sponsored pension. So one is a defined contribution pension plan, the other is defined benefit. So a defined contribution plan, typically what happens with those plans is that you're making a contribution off payroll, your employer is making a contribution, that money gets invested. Typically the employer is asking you to make decisions about how to invest the money. It compounds and grows over the years. When you get to retirement, then you take that capital and you use that capital to generate a retirement income stream. We won't be talking about how to do that in this video, but that's the basic process. And there's a lot of responsibility on your shoulders to manage that plan, and ultimately it'll be your decisions along that journey that will determine how much capital is in that plan and what the income potential is going to be. It's not a guaranteed income plan. The other is a guaranteed income plan, referred to as a defined benefit plan or a formula plan. Now, if you have a formula plan, a really good formula plan would be 2%, this is the formula, 2% times your years of pensionable service times the best 5 years working with your employer. Sometimes it's the best 5 of the last 12. Sometimes it's the career average earnings since you started working with that particular employer. So there's various formulas, but ultimately that formula will drive a specific benefit amount. And once you arrive at that benefit amount, it's guaranteed to be paid out to you by the pension plan that is sponsored by your employer. So what's nice about these plans is that they're giving you a fixed payment. You're not worrying about investment markets. You're not making investment decisions. You're just having money come off your paycheck or your payroll, and it gets invested. And your employer is managing that plan. They've got an actuary, and they're working to make sure that that plan ultimately is fully funded so you can get that pension down the road. The other aspect of that plan is that any shortfalls on defined benefit plans are typically the responsibility of the employer. So yes, you're putting money in, the employer has to put money in, but then they're investing that money, and if things don't go according to plan, it ultimately is their responsibility to make sure the plan is fully funded. So the defined benefit plan has a lot of guarantees that make it very, very beneficial. And when it comes to dealing with lump sums, one of the biggest decisions that people are confronted with is lump sum transfers from defined benefit pension plans. Does it actually make sense to transfer money from a defined benefit plan to your own personal RSP or locked-in RSP account? And that's what we're going to talk about today. Now, I've already alluded to the fact that there's been this transition going on with pension plans that has led to the collapsing of defined benefit plans being offered to employees. And so I'll cover off just a few of the reasons for that. So one reason we talked about already is the potential liability to employers. So if there's a shortfall in a defined benefit pension plan, The employee doesn't really have to worry about that issue. That's the responsibility of the employer to make sure that the plan is fully funded. Now, it may have a ripple effect on the employee. Contribution rates may go up. Maybe the formula gets changed at some point in time. So there are sort of side impacts, but ultimately the core pension plan has to be looked after by the employer. And so in tough economic times or very competitive market environments, companies want to have as much certainty as possible, and having this potential open-ended liability makes it difficult for companies. So a good example is in the 2008 financial crisis, when capital markets plummeted. Employees didn't really have to worry directly about that issue as it relates to a defined benefit pension plan. It was the employers that had to find the money and scramble to make sure that there was an organized process in place to fully fund that pension plan and recover from the market declines. Another reason that's driving that change is mobility of the workforce. So, portability is really important, and for a lot of companies, they just find it easier to administer group RSP plans or defined contribution pension plans as opposed to defined benefit plans. Costs can be another issue. Defined benefit plans are very costly to administer. There's actuarial costs. So there is just a lot of compliance and regulatory oversight in those plans, and a lot of companies just don't want to have to be bothered with that anymore. So whatever the reasons, there's a constellation of reasons, we're just seeing fewer and fewer organizations offering defined benefit plans. If you look at the most prevalent areas where defined benefit plans are offered, typically it'll be in city governments, federal government plans, provincial plans, sometimes crown corporations. So typically the government sector continues to offer defined benefit plans. Universities, again, another common area. But if you look at the private sector and smaller organizations, it's becoming increasingly less and less common for defined benefit plans to be offered. So as a consequence, more and more people are being confronted with a decision on what they do with these pension assets, because as employers wind down their defined benefit plans, they're then confronted with the decision about what do we do with those assets. Do I leave the money with the pension plan? Do I transfer it out to my own RSP account or locked-in retirement account, or to another pension plan? So let's look at the first issue that we need to be thinking about when we're making that particular decision. Well, let's look at point number one. And point number one is cost of living provisions on the pension plan. So with defined benefit pension plans, some plans are just, in fact, this would be the majority of pension plans. Some plans will, you'll accrue that annual income or monthly income when you retire. And once you start taking the income, there'll never be an increase. It's just a flat line fixed income. And so over your retirement lifetime, you'll have to worry about and plan for how you can cope with the impact of inflation, because the purchasing power of that flat income over the retirement years will reduce. Other plans, again, much rarer, but they're still out there, would be defined benefit pension plans that provide a COLA, or a cost of living adjustment. So every year, if there's inflation, as measured, let's say, by the Consumer Price Index or the average increase in wages for that year, then the pension plan is obligated to do an increase. Now, some pension plans contractually don't have to. I mean, it's not built into the contract, but they strive to. So if the pension plan's done well enough, then they'll make an incremental increase. But for those pension plans where it's contractual, then if the Consumer Price Index or the inflation rate goes up, they are required to increase the pension benefit every year. Now, if you have that kind of pension plan, you're very, very fortunate. Now, again, typically the federal government plan is indexed. Many municipal government plans are indexed, or city governments, and federal pension plan is indexed, and some crown corporation pension plans are indexed. So you're getting there's a bit of a theme here. So in the government sector, where the defined benefit plans exist, there tends to be cost of living adjustments. Now, sometimes pension plans will adjust that cost of living right from basis point 1. So what that means is if inflation goes up by 1%, you'll get a 1% increase. If it goes up by 3%, you'll get a 3% increase. Other pension plans will have a formula where they'll go, well, we'll raise the cost of living by X% less the Consumer Price Index. So it doesn't start from $1. There's a bit of a formula around that. But nonetheless, when you're looking at your pension plan and you're trying to make a decision, do I transfer the commuted value and I start controlling it, if that's an option, or do I leave it with the pension plan? One of the big factors is this pension plan indexed? Will it go up over time to cope with inflation? And what we find generally is where you have a pension plan where that is built into the contractual provisions of the plan is very, very beneficial. It's very seldom that we see people moving money from a commuted value standpoint to their own account when the pension plan is indexed. Over the last third of your life in retirement, that really adds up over time. Plus, it gives people a lot of peace of mind that every month or every year, their pension plan will at least keep in pace, if not fully with inflation, it'll at least be partially indexed over time. Okay, so that's point number one. Ask yourself the question, is there a cost of living allowance and indexing on the pension plan? If there is no allowance, then many times it can make sense to transfer. It's not the only issue to look at, but it may make sense to transfer the assets. If there is indexing, more often than not, it makes sense just to keep the pension plan in place. Don't transfer the commuted value. Okay, let's take a look at point number two. And point number two is pension sustainability. How is your pension plan holding up today, and what will the pension plan look like in 20 years? Now, when it comes to pension sustainability, what we're really getting at is that plan going to be around? Are you concerned about the sustainability? So I talked about the compliance and regulatory side of pension plans. In other words, when there's a defined benefit plan, a formula plan, there's a lot of regulatory oversight on those plans. If there's a plan that is not funded properly, then government regulators will kind of put some pressure on that plan to make sure it's fully funded. But you still hear examples of organizations going under that had a defined benefit pension plan, also had creditors, and for whatever reason, those commitments were never really honored the way they were supposed to be. Now, you hear about those cases less and less. I think the regulatory oversight is pretty good generally in this area. But if you're working for an organization where there's financial distress, you don't see the long-term future of this company looking very good, then I think you do want to take a real close look at your pension plan. And if you have the ability to take out the commuted value or lump sum value on that plan and move that out to a plan that you can control, then you want to look seriously at that. So you just put your ear to the ground. What's your sense about that company? Do you have the option to move the assets? The plan may look really, really good, but if the sustainability long-term of that company doesn't look great, that may be one reason why you would transfer money out. Now, another reason is just frustration. So I talked about the fact that organizations are either moving away from defined benefit plans to defined contribution plans or group RSPs, or they're doing things like changing the benefits. You could have a defined benefit plan that had cost of living, and then they move away from cost of living, so they eliminate that from the plan. Maybe they're being forced to increase the contribution rates. So they begin toying with the formula, and it creates a little bit of frustration, and they're really reducing the benefit of that pension plan over time. As they make those changes, then it may direct you at some point to say, you know what, I'm not going to keep the money in the pension plan anymore. It's not the pension plan I used to have. They're making changes to it, and I'm concerned about the direction this pension plan is going. So that's point number two. That's a bit of a red flag. I mean, it's not as simple as just, anecdotally looking at it, but it'll be a red flag for you. If you see changes to the pension plan that don't seem to be working in your favor, or if you see that the company itself is struggling or maybe struggling in terms of the industry that it's in, begin to really pay attention to your pension plan. And maybe one of the solutions is to move out of that plan, take control of your assets, and move it to a plan that you control. Okay, we're going to take a look at point number three, and that's flexibility. Flexibility around your pension options. So again, we've got this pension plan. We're confronted with the opportunity to move the commuted value, the lump sum value from the pension plan into a plan that we can control. So again, why would you do that? Well, under point number three around flexibility is because you might have just a feeling that when you look at your own retirement, you want to match your cash flow to your energy. So when I talk to a lot of clients, one of the things they do say is, we want to make sure that we're pursuing our recreational goals and our aspirational goals and leisure and travel goals in the first 10 or 15 years of our retirement. That's the time we're going to have the most amount of energy, and we'll be more active, and so we want to bump up our cash flow during that time frame. So trying to match your cash flows, your after-tax income streams with your life cycle and your lifestyle is a great option to have. So when you take control of your financial assets, you can match those cash flows much more precisely. So that's one of the benefits of taking control of your pension. Because with pension plans typically, and typically a defined benefit plan is once you retire, you get your monthly income and it's static. Yes, there might be some incremental increases because of cost of living adjustments, but for the most part, there's not much of a change. And it's not like you can reach into that pension value and take out some lump sums or extra cash flow because you want to do some more traveling. You're on a fixed income and you have to balance your cash flow needs with what you want to be doing, or setting aside money to do the extra traveling that you're doing. Now, some people actually have a pretty cynical feeling about life expectancy. So again, one of the reasons they would like to take control of the pension money is because they want to front-end load the cash flows when they're younger and they have their health. Now, I'm going to share with you a little bit more detail around the flexibility, because I think when we talk about this, you need to understand the mechanics around how you move the money from the defined benefit pension plan and the commuted value, where that money goes, and then what are the account options that you can utilize to create that flexibility. So let's take a look at that right now.
Now, what I'd like to do is sort of give you a bit of a schematic or drawing on talking about the flexibility around pension decisions. So I've just drawn a box here. This is your employer pension plan. And again, we're talking more specifically around defined benefit or formula plans. So you've got this employee pension, and we'll say the commuted value or the actuarial value is $500,000. At this point, the numbers are not really that important. It's just more the illustration. So in that defined benefit pension plan, if I leave the money in that plan, I go talk to my benefits consultant, and they say to me, well, when you retire, we're going to give you $2,000 per month for the rest of your life. If you're fortunate, your pension plan may have some cost of living allowances that will increase the pension plan over time. So that's becoming less common in the private sector, but if you look at many government organizations still have cost of living, or at least partial cost of living indexing. So that monthly income of $2,000 per month could actually go up over time if there's a cost of living provision. Okay, so at that level, it's pretty straightforward. And if you have a financial plan and you're trying to lock down your basic income, you don't want any changes to it, then this might be the option that makes most sense for you. But there can be people who, when they do their financial planning and philosophically look at how they want to handle their retirement, they may go, well, what if I wanted to reach into this commuted value? Maybe not a ton of money is going to come out over and above the monthly income, but I want to take some money out for some additional traveling or experiences I want to have, particularly in the first 10, 15 years of retirement when I have my health and my energy and I'm going to be more active. Well, with a defined benefit plan, what's happening is you're annuitizing the capital. You have no access to this capital after this monthly income starts. When you've bought the annuity or you've got the pension plan happening, you're not going to be able to reach in and access that capital. So you're going to have to either budget around this money for traveling and other lifestyle, or you've got money set aside in other accounts where you can do that. Now, another option is to set up an account that allows you to get away from this problem. The problem is a fixed income, no ability to customize your cash flow, and that really is an option for those people that want to have that flexibility. Okay, it's not for everyone. It's actually very important we look at this in the context of a retirement plan. So you should sit down with your financial advisor and map out that strategy. So let's say that you are looking at your philosophy around income and you don't want to go with the fixed rate payment. What you'd like to do is accelerate and spend more in the front end of your retirement years and then go back to a basic lifestyle expense when you're older, because you believe that you're going to have more energy and you want to be doing more things at that point in time. Well, with most pension plans, you'll have the option when you retire at some point, and not all plans have this option, but many do, that when you retire and you have this $500,000 of commuted value, in our jurisdiction, the individual has the ability to transfer this $500,000 out, and ultimately the end result is 50% of the capital can be put into what's called a life income fund option, and the other 50% can be put into a prescribed RIF. Now, the nice thing about the prescribed RIF is there's no maximum on your payments. Now, theoretically, if you had $250,000 of capital here and $250,000 of capital here, the $250,000 on this side, you could take it out theoretically all in 1 year. Now, you wouldn't do that. That wouldn't be prudent. But what it allows you to do is to accelerate your rate of expenses in that first 10 or 15 years to provide more lifestyle or experiences in line with your philosophy around spending through your retirement years. Now, the $250,000 on this side, there are restrictions. There is a maximum and a minimum on this account. So the governments have set it up so that they're trying to make sure that you don't have more life than income on this account. As well, you always have the option to move this money to an annuity option, so there's a fixed monthly payment. So this piece is pretty conservative, and this piece gives you lots of flexibility. So I have a lot of clients over the years that have elected for this option because for various reasons they didn't have a lot of side savings. They had some, but when we worked through the retirement plan, we knew that on this side, with whether annuity or a life income fund, plus their Canada pension plan, plus their old age security benefits, that we could look after the basic lifestyle expenses. No issues there. And so they viewed the PRIF assets, where there's no maximum, as the bucket that they could reach into to accentuate lifestyle. Now, it's important to keep in mind when you're watching this video that every jurisdiction in the province is going to be a little bit different. So I'm in the province of Manitoba. This is the basic layout. There's more details than this, but this is the basic lay of the land in terms of options or what from pension assets, where there's locked-in assets. In the province next to us, in Saskatchewan, there's no restrictions on pension assets. Federal government has different guidelines compared to various provincial pension plans. So it's a bit of a dog's breakfast in terms of the different jurisdictions. But the main point here is that likely when you sit down with your advisor or pension administrator and start exploring options, you probably have the option to take some level of control over your pension assets so you can begin matching your expenditure and income to the philosophy that you have around retirement. Okay, so that's the main point. And you just want to start doing your research and finding out what your options will be at some point down the road. I think the really important takeaway is that for many clients, like I said, they want their cake and eat it too. So on this side, whether it's a life income fund or whether it's an annuity, in addition to government benefits, they want to make sure this piece is looked after, and then they use this piece from the pension plan to accentuate lifestyle.
Okay, let's look at point number 4, and that's your age. What if you change careers? Again, I think your age has a really big impact on your approach to transferring out commuted value. So on the one end of the spectrum is if you are 55 years of age or 60 years of age and you're confronted with this idea of taking commuted value, you need to look really, really carefully at that, because you're now at a point where you're going to begin generating income, and you need to worry about market risk and variability of return. And for many people, they like to have a baseline income that they can just count on. Now, that doesn't mean that you don't have investment options available to you in your own account that can be guaranteed and very conservative. But age does have an impact. So as you get older, you tend to see people, not as much, but sometimes it makes sense, want to take less control of the assets, leave the money with the pension plan, just get their monthly income check. Now, a lot of the work that we do for our clients who are just on the cusp of retirement is to try to give them their cake and have the ability to eat it too. In other words, they want to have the ability to take control of the pension, but they want to make sure that their non-discretionary expenses are looked after. So when you retire, you want to be really clear on what are our non-discretionary basic expenses that will never change, and then what are our discretionary or extra lifestyle expenses. With pension income or with other investment strategies, you want to make sure you cover off that non-discretionary or basic expenditure line first. It's really important that you do that. So when you're older, sometimes people like to leave the money with the pension plan just to guarantee that monthly income to supplement Canada pension plan, old age security, and other fixed income payments as a foundational piece of their plan. Now, when it comes to younger employees, one of the issues that they are concerned about is portability of pension assets. The average worker now is going to change employers several times, and so it's actually not realistic to expect for most people that when they have a pension plan with a company, it's always going to be there or not go through changes. So what a lot of people like to do is they've got their locked-in retirement accounts or their RSP accounts set up, And as they move from one employer to another, they'll typically take that commuted value and move it into a plan that they can control. So over time, they're consolidating those assets to one particular plan. And they're not dealing with a whole bunch of little pension plans, 20 years down the road or longer when they retire. The other thing is when you're younger, you're not as concerned about market volatility, and flexibility, and consolidation of the assets tends to be a little more important for people. So that's point number 4, your age. The closer you are to retirement, the more you really want to be very clear about your discretionary and non-discretionary assets and whether that pension is going to cover some of those basic expenses as part of your plan. You can still do that on your own, and some people will take the money out of that pension plan because they like the control factor, right? That flexibility. And you can still have securities and investments in your portfolio that mimic the pension plan in terms of the guarantees. Okay, so that's point number 4. Okay, let's look at point number 5, and that's life expectancy. So if we're thinking about transferring commuted value or pension value from our employer-sponsored pension plan and taking control over it, life expectancy is an important consideration. Does your family have longevity in it? What's your sense about that number? Of course, there's no guarantees when it comes to our life expectancy. But the reality is people are living longer and longer. And so when we make these decisions, one of the risks that people need to worry about and do worry about when it comes to the retirement plan is longevity risk. I don't want to have more life than income. So one of the nice things about defined benefit pension plans and annuities is that you never have to worry about outliving that income. Now you can build an annuity program by taking control of pension assets. In fact, very often we have clients where they're confronted with a decision to move commuted value, and the company gives them a monthly income quote, and then we take that same lump sum value amount and we go out to insurance companies and get quotes, and we find that the insurance companies' quotes are very close to what the pension plan is offering. In those particular scenarios, what we say to clients is, listen, there's no downside here. If you take control of the money, then it gets put into your account. If ultimately you want to have an annuity and a monthly income, if it's the same as what the pension plan's quoting, that's always an option for you. But you have the additional benefit of having flexibility and more control over those assets. So it's an open question, right? Longevity, protecting yourself. Can you do the same thing by taking control of your own pension? Yes, of course you can through annuity purchases. And we'll give you an example of that particular question. So just as I finish this section, we're going to go through a real life example of a client that was confronted with, do I move the money from the pension plan? They're giving me this quote in terms of monthly income. What can I get if I annuitized? Even if that client didn't annuitize, they had the peace of mind knowing that they weren't making a financial decision that was in any way hurting them. Now, some people have very short life expectancy, and so what they want to do is front-end load. Again, we've talked about this, cash flow at the beginning of the retirement. I'm not saying that's necessarily the best strategy in the world. Have clients, and I know of people who were very pessimistic about their life expectancy and way overshot the length of time that they thought they would be on this planet. So it's a little bit of a risky strategy, but longevity, life expectancy, you need to take that into account. And let's take a look at a specific example that might be helpful for you.
Okay, I want to give you a specific example. So we had a client come in, and they were about to retire, and so they had a employer-sponsored defined benefit pension plan. So again, that's a formula plan. So they just took a look at their years of service times the average of their best 5 years, and there's a benefit rate that they applied. And after doing that calculation, they confirmed to the client that their monthly income when they retired was $1,323 per month on a pre-tax basis. Now, one of the things that impacted this income is that with pension plans, unless the spouse signs off on a survivor benefit, there's a requirement to have a survivor benefit on the pension plan. So this income could be a little bit higher had there not been any survivorship benefits, but if you have a partner, there's a statutory requirement to have a survivorship benefit. This client was looking at putting a 50% survivorship benefit on the pension plan. Well, that meant that as long as the client was living, they would receive $1,323 a month for the rest of their life. If they predeceased their partner, then their partner would get 50% of this $1,323 for the rest of their life. On the death of the last of them, the income would cease. They also were putting a 5-year guarantee on this potential plan. And what that meant that when they retired, if one partner predeceased the other, let's say in the first year, and then the second partner died in year 3, there would still be at least 2 more years of income payments that would continue to be paid to the estate. So you sometimes see people put guarantee periods, 5-year guarantees or 10-year guarantees. In that worst case scenario, if something happened catastrophically, they die prematurely, you sometimes see people wanting to get at least some value out of the pension plan no matter what. So they wanted to get a 5-year guarantee put on the plan. Okay, so $13.23 a month, 50% survivorship benefit to the spouse if the client passed away prematurely, and then a 5-year guarantee that makes sure the pension plan, as long as one of them living, these income payments continue for the rest of their lives. But upon both of their death, there would be an extra, payments up to the 5-year guarantee. Now, once you get past that 5-year guarantee, so let's say they were annuitized and they're both gone by year 6, as an example, then there's no residual benefit that would go to them. As well, there's no indexing on this particular pension plan, so it made the calculations fairly straightforward. And one final point is the computed value on that pension plan was $320,000. So what the actuaries do is they take a look at the client's age, they take a look at prevailing interest rates, they take a look at the formula, the annuity amount that they have to generate. So based on the formula, the annuities, the actuaries basically say, okay, if you were to take control of the pension assets, we'd have to give you $320,000 of capital that you can then take to an insurance company, as an example, or to your advisor to begin generating income. So what we did is we said to the client, well, if we took $320,000 of capital, how much income would that generate for you? And so this is an example of an annuity quote. So this is 3 insurance companies quoted. And you can see the top insurance company in this estimate was quoting $1,302 per month. And in this estimate is $1,323. So not a real big difference in income, pretty close. So once we did our homework and found that if she took control of the $320,000 of capital and was able to generate an income that's comparable to what the pension was quoting, all of a sudden a whole bunch of options begin to open up to the client. So again, when you look at the various options, we talked about this in a previous section, you've got the pension plan. And so one of the options that the client had was to simply just move the money to their own LIRA, or locked-in retirement account, and then ultimately buy an annuity. And as I just showed you, that annuity was giving exactly the same income, not exactly, but almost the same income as if she just left the money in the pension plan. Now, why would you move it then? Well, why you'd move it then is because this client wasn't exactly sure that they wanted to annuitize it. Before making any decisions, they wanted to know that if they did want to buy an annuity, that they weren't falling behind, that there wasn't a major disadvantage of taking control of the capital. But remember that $320,000 that this client has access to, they have the option to, again, they'd have to transfer a minimum of 50% of the portfolio to a life income fund, and then the other 50% can go to a prescribed RIF. Now remember, the prescribed RIF, there's complete flexibility. You can take that capital and do whatever you want with it. You can spend it all in 1 year or over a number of years. And then the LIF is a life income fund, and you can also have an annuity over here as well. Okay, so at the end of the day, what the client clearly saw is that if they decided to purchase an annuity, which is essentially what this income is from the pension plan, they would be in the same spot, whether they kept the money with the pension plan or took control of it. So now that they know that if they took control of the money, they could generate exactly the same guaranteed income through a life annuity, then it basically opens up some options for them. So that if they said, well, at the end of the day, I'm not sure what I want to do. And in fact, although I'm retiring from this company today, I may not be fully retired because I'm consulting for 4 or 5 years. So, you know what? Maybe at some point I'm just going to do 50% of this is going to go to an annuity, and the other 50% I want to have more flexibility and control over. So the client felt empowered to make the pension transfer because they knew that at the end of the day, worst case scenario, if they just went with a guaranteed income payment, they were in the same spot, but they have all these additional options open up to them in terms of income payments from the portfolio. Okay, so it's really important that when you're confronted with these decisions that you do these calculations, that you get annuity quotes, you compare the differences, and then integrate this into the overall retirement plan.
Okay, point number 6 is control. Where are the funds being invested? What kind of return are you getting? And for some individual, this is a really important consideration. So when you have a pension plan through your employer, often they'll report back to you what the returns were for the year. And for some people, they'll take a look at that and go, you know what, I could have done a lot better than that, or I can do a lot better than that over time. So what pension plans will do typically is they'll hire the actuary. There's contributions going into the plan. The actuary will sort of look at the the expected returns that they should be trying to achieve to meet their actuarial commitments to fund monthly income for pensioners. And for some people, they may believe that they can get a better return than what the pension plan can get. And that may in fact be the case. If you have a younger investor and they want to be really aggressive with their portfolio and they have a runway of the next 30 years, they may believe that using that approach they can actually accumulate more capital and have a higher income than what they could get from their pension plan. Again, it's one of the factors to take into account when you're trying to decide whether you're going to move the pension assets. That may not be the only factor. So when you look at the constellation of all the things we're talking about, I don't think you would transfer the money out just because of control and investment flexibility. It'd be one of the things you'd look at, but it wouldn't be the deciding factor. Particularly when you think about pension plans being a foundational part of your plan. In other words, you want predictable monthly income and you want to make sure that that money's there for you down the road. When you take control of the assets yourself, you pursue a very aggressive strategy and you make the assumption that's going to work out for you, it may, but the stats are probably against that happening. So when people take control of their own assets, particularly if they're not working with an advisor or financial consultant, they tend to make sometimes big mistakes along the way that can really hurt their performance. But again, point number 6, do you want control? Do you want to have the ability to invest the money yourself and not have it done through the pension plan? That might be one reason why you would transfer money out. Okay, let's look at point number 7. This is the last point that we're going to cover off, and this is around the issue of estate and legacy goals. What are your legacy goals? And that's going to have an impact on your approach to this pension decision. So keep in mind, I don't think I've talked about this yet in the presentation, is when you have a defined benefit pension plan, when you elect to take a pension from that program, you also, if you have a partner or spouse, you have to elect for what are called survivorship benefits. So upon your death, you need to guarantee there'll be an income that would be paid to your spouse or partner for the rest of their life. But past that decision, there's no residual value typically that'll be in that pension plan if both you and your partner die. So for some people, if legacy aspirations are really important to them, they may rather want the money to go to their investment accounts and take control of those assets. So upon their death and the death of a partner, if there's money still in that pension pot, they can then have that money going to their estate and going to beneficiaries or directly to their kids, as an example. So when you're looking at your planning objectives around this pension decision, legacy and estate considerations can play a role. So again, pension plans are really designed to provide income both for you and your partner, but past that, there's usually not a lot of residual value that would go to families. When you transfer that commuted value or lump sum value out, then that presents a potential opportunity that there's a estate value that will go to your family. So you need to work that into your decision making. So when you think about it, let's say I've got a client where we have a commuted value option, We also know we can buy annuities to get the same level of income if they took control of it. Maybe they annuitize some money, but they keep some money in more flexible liquid financial assets. And so they're trying to get both jobs done. One is to create legacy, and the other is to provide predictable monthly income. So I want to give you an example of that right now, how that could work. So let's take a look at that.
So to discuss the estate planning sort of residual value piece in the overall decision about taking control of community value, just going back to that estimate that I gave to you before. So remember that client, they knew that they can get $1,323 per month. They did put a 5-year guarantee on the contract, but they knew that if both they and their spouse live past the 5 years, now they could live many, many years past that, but if they died in year 6 forward, there was no residual benefit, no estate value. So although the pension plan guarantees income for the couple, it doesn't have that residual value that they may want to go to their estate, ultimately to their kids, maybe charities or community. So when you look at the pension options with both the LIF, the Life Income Fund, and the PRIF, depending on the client's financial situation, they could go with what's we refer to as just a minimum payment on the account. So they can go with a minimum withdrawal on both plans. And what that's going to do is it's, likely the accounts will draw down over time. So you're killing the goose that lays the golden egg, unless you have, great success in terms of investment returns. Because what happens if as you're taking the money out, these minimums start ratcheting up into your 70s and 80s, 5, 6, 7, 8%. So will you be able to get 7 or 8% in your 70s or 80s? Probably not. You're probably going to be more cautious. And so the RIF minimum payment that you're required to take out is larger than the actual return that you're likely to get in the portfolio. So you do see a slow drawdown. But, going out to those latter years of your retirement, there is this residual value. And so you can refer to this as estate value. So sometimes you see, I don't think this should be the only reason you would take commuted value, but one of the reasons that you see people taking commuted value on all or maybe a portion of their pension plans is to create this estate value scenario. So I talked previously in this video about some people taking the commuted value out on the 50% that has to go to a LIF or annuity. They annuitize that, and then the PRIF, they minimize the drawdowns, and that's their estate value because they've done the calculations and they know that they can maintain their basic lifestyle on the LIF payment or the annuity payment and Canada Pension Plan and old age security benefits. Okay, so hopefully that's helpful. It kind of gives you the context for where the estate planning piece comes into play.
Well, it's my hope that you found this presentation helpful. We've talked about the 7 key points to keep in mind when you're confronted with a decision to transfer commuted value or lump sum value from your pension plan. So the first point we talked about was, is there cost of living provisions on the pension plan? So will it be increased to help you cope with inflationary impacts? Is the pension plan sustainable? So what's the health of the company that sponsors the plan, and are they making changes all the time? And you're getting a little bit pessimistic about how that plan is structured. What about flexibility? Is flexibility around the plan and accessing the plan to match your cash flow needs with your lifestyle, is that important, or you'd rather just want a basic income to cover basic expenses? So the flexibility issue is an important one. What about your age? Age can influence. When you're younger, you tend to be more open to more flexible options and taking control. I find that clients, as they get older, yes, they'll look at those options, but they also have a very strong predisposition to have certainty of income in their planning. What about life expectancy? One of the nice things about defined benefit pension plans or annuities, if you take control of your own pension assets, is you never outlive the income stream. So that has to be considered. Control, we talked about that again. More specifically around investment flexibility and control, and so you have to work that into your decision making. And then finally, your estate considerations. So some people really view their pension assets as part of their estate and legacy plan, and so that's one of the reasons why they want to take control of the assets. Again, other people just view it as an income stream. They'll get income for their life, and their partner will get income. If there's nothing left past that point, they're not concerned about that.
We've got another video dealing with pension plans, so make sure you click the box. Click to subscribe. Don't miss the great content we post on a regular basis. Visit our website, humphreyswealthgroup.com, for great resources. And in the show notes, you have a link that you can get to our coaching and retirement planning services.